Well, my next guest has built a reputation making some great calls, including the 1987 stock market crash, the housing bubble, and most recently, the commodity bubble and near free fall we saw this year. Kind of spooky that you predicted all of that. Michael Aronstein, Chief Investment Strategist at Oscar Gruss Son, is here with me now in the studio. You've been right on both the upside and the downside. So I want to stick with commodities. I want to start off with that. I mean, you've been calling basically for a bull run. I don't want to misquote you, but sort of an increase in commodities since February. I mean, has your view changed on this at all?
No, not much. I think, the consensus view of the economy is starting to creep more toward our view. We've been in the camp that we're going to get a V-shaped economic recovery in the United States.
Which is not consensus.
Which I think is pretty far outside of the consensus. And that's going to have a predictable effect on most assets that have cyclical correlation, including commodities, where I think you may have a little more upside because some of the traditional industrial consumers of them are not hedged at all. And typically, a lot of the buyers of these basic materials will buy forward at least a year or so, try and assure some price stability going forward. Many of them are completely unhedged now, almost living hand to mouth, which is normally a sign that prices are going to go higher. At the point where they throw in the towel and say we'd better hedge our exposures, that's usually the terminus phase.
Now, we have seen oil prices rise from the beginning of this year, particularly from February, but it hasn't gone up as much as we saw them go up last year. So the fact of the matter is that it's been a lot more smooth. In that sense, the rise that you see in crude oil, is it going to be a lot higher, or are we just talking about maybe a 10% increase from here?
Crude's a tough one to really call because that's a market that really it's influenced tremendously by investment flows because the energy complex is such a large aspect of all these commodity indices. So flows in and out of those have a really disproportionate effect. We don't have any positions in crude or the complex. It's much more in the industrial metals, some of the areas where other people find it difficult to invest.
Oil companies so cheap you need to buy into them?
I don't have a strong view on that. No, I think it's a sector that's heavily represented in the S&P, and I think people are going to be scrambling here to have more equity representation. So to the extent that they push money into kind of index correlates, they're going to wind up having a fair amount of flow into the energy sector. I think the stock should do fine. Of course, there's the whole climate change kind of legislation hanging over their heads.
It's right, and that's always sort of that's a wild card essentially for these companies. But Michael, I've only got you for about 30 more seconds, so I want to ask you about the economy because you just said that you see a V-shaped recovery. So tell our viewers, why are you so out of the consensus in that?
Well, I think focusing on the chain of causation and the downside, which was essentially a collapse in the function of global capital markets for 2 months. They shut down. And following that, the global economies, as you might expect, shut down. So you had an external shock, which has now been removed. So the rate of change on the downside in almost all the economic indicators was so abnormal that as those pressures of a closed-off capital market begin to abate, all these things will recover in a manner that statistically looks like a really powerful recovery.
Okay, Michael, next time we'll have to bring you on to talk more about home building stocks and other places that you're buying. So thanks so much for joining us. Michael Aronstein of Oscar Gruss